Welcome to a financial short take. In this episode, we will quickly cover the Fed's current rate policy and how that affects equities. Let's dive into it. Right now, the Federal Reserve is raising rates while simultaneously tightening their balance sheet, which is called quantitative tightening. This usually always leads to sell-offs in equities, lower valuations on companies, etc., right? The longer they tighten, the worse all domestic markets tend to get because the difficulty to service that debt becomes so high. When the Fed eases and lowers the rates and starts quantitative easing, at first the market reacts by selling off because they think something must be wrong for the Fed to change course like this, so the market reprices for lower economic and earnings growth rates. But eventually, because the cheap cost of money, equities markets will pump. Right now, a lot of bulls are waiting for this policy pivot. Let's explore historically the reaction when the Fed does in fact pivot. So we can go all the way back to 1964. And we see that each time the Fed pivots, there was a negative reaction on S&P 500 from anywhere between 15% to the worst at 58% of a reaction, and that was during the Great Financial Crisis. So save that on the screen for just a second. Next, keep in mind that the Fed pivot itself would have to be twofold. They stop raising rates and start lowering them, getting closer to zero bound, and two, they stop quantitative tightening and immediately start quantitative easing or easing to add liquidity to the markets. The chart you're looking at now proves our core point, that these periods of zero rates and monetary accommodation fuel asset prices higher. Periods of balance sheet contraction and higher rates lead to market sell-offs. It's undeniable that the Fed is in a truly tough spot right now. Can they keep raising rates to fight off inflation and get that to drop closer to 2 or 3%, which is their mandate, in time before they gridlock markets and completely freeze everything up and cause mass liquidation events by raising rates too high? Only time will tell. Most banks' predictions are interest rates somewhere between 4 to 5% by the end of 2022, with inflation dropping to 3 to 4% in quarter one of 2023. I'd love to hear your thoughts in the comments below. Thanks for tuning in.